This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Welcome. So in this podcast, we're talking about empowering healthy business in general, and at its core, we're talking about financial health, and that can mean profit, it can mean cash flow, it can mean sustainability, maybe scalability to grow, getting a return on invested capital in the business. Maybe it means financial planning and analysis around new business lines or M&A transactions. From the context of small businesses, who is our target audience for this podcast, we're talking about businesses typically less than $20 million in annual revenue. And unless they're a well-financed, venture-backed company with at least a couple of rounds of financing under their belt, they probably cannot afford a full-time CFO. And frankly, they probably don't need one either, because there's certainly not 40 hours a week of real CFO work to be done in most small businesses either. And so these days they can turn to the fractional CFO model. And joining me today is Dave Hartley, who runs the client advisory practice at Ander CPA, where a large part of that practice is virtual or fractional or whatever you call part-time CFO services. And so these days we may have, fractional VP of sales, fractional chief operating officer, fractional VP of HR. But the fractional CFO is really the granddaddy of them all, kind of the first kind of fractional C-level model that really came to market a couple decades back. And so today, Dave is going to help us explore how to create successful fractional CFO engagements. And it's important to understand how the fractional CFO model is different than the full-time CFO model. So welcome to the show, Dave.
Thanks, Cal. It's great to be here. Look forward to sharing my thoughts and experiences with your audience.
Great. So kind of what's your background that brought you to this fractional CFO space? How long have you been doing it?
Yeah. So I've actually been doing professional services for over 3 decades. I actually started, got a degree in accounting, passed the CPA exam, started doing external audit in the Big Four, and then transitioned to IT audit, and then ultimately to consulting. And so I've advised clients for 30 plus years. And most recently, my focus has been on the lower middle market. So companies 30 million, 20 million and under. So happy to be here and talking about sort of what we do in virtual CFO services and how companies can really get value from those types of solutions.
Great. So maybe we can, start at the beginning of this episode geared around, if I'm a small business owner, how do I, set myself up for success if I engage with a fractional CFO? And so, before I make that decision, I guess I need to come to a realization that maybe I should engage with a fractional CFO. And so what are some of the signs or symptoms that would, suggest maybe I should be working with a fractional CFO?
Yeah. And Cal, I thought your intro was great because they're generally, for smaller clients, say 20 million and under, there generally is not enough business to keep a CFO busy full-time. And then also generally a business that small can't afford to have a full-time CFO. So I think, this is a relatively new entrant into the market. And so I think it's important for companies even to be aware that this is an option. Because in the old days, what would you do? I mean, when you had a technology opening or an accounting opening, you just go hire somebody because there were people available and on the market. And I think what you'll find now, we have a lot of clients in that space who come to us and say, I just can't attract the talent that I need, either in accounting or in technology. Can you help with that? Can you outsource that? And so I think a lot of professional services firms are seeing that need. So the concept of really a virtual back office is really gaining steam, where virtual CFO, virtual CIO, virtual CHRO, those types of services delivered on a fractional basis are a perfect fit for the 30 million and under crowd. And I think, Cal, also in your intro, you went through sort of a list of these are all of the types of things, whether it's capital for you want to launch a new location, or you want to get funding, or whatever. I mean, there's so many different needs that businesses have, and generally it's hard to find one person that has all of that experience. And that's where finding a firm that can deliver these services fractionally can be perfect, because then they have access to those types of resources. So it is important to understand really what you want out of this relationship, to make it as effective as it can be.
So titles can be pretty cheap, especially in small businesses. So there are a lot of people walking around with controller titles or CFO titles who really spend most of their time doing accounting or bookkeeping. And so could you help, kind of explain some of the differences between these roles, and what is the nature of the work that's, we call a really kind of true CFO work, where we need to bring in somebody who really has that skill and experience?
Yeah. So Cal, I'll answer that question, and I'll describe kind of how my firm does it, but I think that will help people just understand what the options are. So in our world, there's actually 3 levels of services. So the lowest level is the more transactional accounting, making sure that the books and records are accurate, whether it's payroll, accounts payable, any of those types of things, making sure that is taken care of. A higher level of service is controller. So our controller level service is more focused on making sure that all the things I just described in the transactional level are done right. But then you're starting to do some more things. You're interacting with the client at a higher level, and maybe you have a meeting a month where you go through the financial statements, you talk through some of the business challenges, those types of things. And that can be incredibly valuable as well. But then I think where companies get the most value is that true virtual CFO relationship. And the key to that is really, what are the key business decisions or the key business issues that your business is facing? And then how can a virtual CFO help you with those decisions? And I think that's a key part of the relationship, is understanding that this is someone that's going to be a virtual CFO, is someone that you really need to let into your business, and you need to trust this person, and you need to share with them what your challenges are, what your issues are. If this is a relationship that you're not comfortable with, that you think, maybe I'll try this person, but I really won't share everything with them, that's probably not the relationship you're going to get, because you want a relationship where you can share everything. And if you find the right virtual CFO relationship, you have somebody that can really bring a lot of value to the conversation about the business issues that you're dealing with, whatever they are.
Great. And so, could you talk a little bit about the differences between what you would expect to get with a full-time CFO, who's an employee and officer of the business, versus a fractional CFO who is more of a quote-unquote consultant?
Yeah, and I think if you are there 40 hours a week and you're in all of the meetings, not just some of the meetings, but you're in all of the meetings, that is going to be a better, deeper relationship. But as we mentioned before, generally there's not 40 hours a week worth of work that the CFO needs to do. And the cost of that person is so high that it prohibits a lot of businesses from even having that as an option. So that's where the virtual CFO solution is a perfect fit, because it solves both of those dilemmas. And so, one of the key things that's part of our model is that we insist that we meet with you, with the leadership team, with you. If you have a weekly meeting with your leadership team, that's one of the meetings that we participate in, because we want to understand what are the key challenges facing the business, because there may be insights and solutions that a virtual CFO can bring to you that you may not either be aware of or understand even what your options are. So a good virtual CFO is going to participate in those meetings. They're going to have a lot of interaction with you. And then during that weekly 1-hour meeting, that's where a lot of solutions are going to be discussed, issues are going to be addressed, those types of things. And that intimate weekly relationship, that conversation that happens, and over time, as the virtual CFO gets to better understand your business, that's when there's a lot of value, because then your virtual CFO starts actually becoming much more proactive and looking at what's coming. And when we think about budgeting, okay, well, you said in the second quarter you were going to do this. Let's talk about that, because we're behind in Q1. So how does that impact Q2? That's where the virtual CFO will bring a lot of really challenge the situation to better understand and sort of force a conversation that needs to be had rather than just kind of crossing your fingers and hoping everything works out.
Right, right. And so if you've come to the conclusion that you think you'd benefit from a fractional CFO, what are the first steps in that process, in the buying process?
So I think the first thing is just doing your research, because there are a lot of different, so let's contrast sort of virtual CFO solutions. Like our model that we deliver, our virtual CFO model is done entirely remote. For some businesses that works perfect. For other business owners, that's not so great. So, you need to really understand what the model is and how it's going to be done. So the virtual CFO piece, or another model, and this is common in almost every market across the country, but there's fractional CFOs that are available that are in your local market. And that may be a person that actually comes on site 1 day, 2 days a week, that kind of thing, and is providing, sort of a different relationship. And so I think one of the key things that needs to happen first is really that research where, go out, search, virtual CFO services, fractional CFO services, and find out what's available. And you may find, in your market, there's a couple of good fractional CFOs who are doing great work. And then you also may look, to national firms who are doing, this. And I think one of the big differences, one of the things I would recommend as well, is sort of understanding the models that they use, how they deliver the service. You should be able to get a lot of that information off of websites and business social media and those types of things. Once you understand that, I think one of the differentiators also then for sort of that second step is, okay, they may be good at general accounting type things, but then how much do I want them to know and understand about my industry and my particular business? So there are nuances, whether you're a coffee shop, there's certain KPIs and metrics that are key for that business versus if you're a transportation business or, whatever you are, there's nuances to that business. There's lingo, there's, a definition of how the business operates, the metrics that are used. So all of that can be really helpful to find a person that really understands your industry. And, because otherwise they can provide good general advice, relationships with banks and those types of things. But in terms of, do you really want them to be, either, a true national expert in your business, or when you have that first conversation with them, they're like, okay, answer these few questions for me. And then they can basically say, oh, you're way out of line with sort of the industry benchmarks. Your cost in this area is too high. We really need to look at this because your inventory turns are not what they should be. Those types of things. That's where somebody who really knows the industry and has worked with similar businesses can bring a ton of value right out of the gate.
Right. So speaking of bringing value right out of the gate, when you hire an employee, you expect it's going to take some number of weeks or months for them to get up to speed. What should you expect of a fractional CFO in terms of time to get up to speed to be able to understand your business enough and start to be able to have a real impact?
Well, I think and that's a great point. And we do have a significant focus on onboarding as part of what we do, because we want to make sure that we're delivering value as soon as we can in that client relationship. So I think it depends on, sort of what the nature of the relationship is. If this firm or person is going to come in, take over all of your accounting, a lot of times, a lot of clients that we pick up, they're struggling. They're behind in doing reconciliations. They haven't produced financial reports in the last couple of months, and they really need help. So if that's the case, you have to be realistic and talk about expectations with your virtual CFO around how long it will take. And there are some instances where, things are a mess that you come in and it's probably going to be 4, 8, 12 weeks before things are really fixed. And then you can, that everything starts to happen the way that the full relationship should. But that doesn't prevent from day one somebody being able to have conversations with you about your business, discuss pressing business issues, and start to learn and understand. So it's not a relationship that should take years to produce value, but there is kind of an onboarding period, and you need to have clear discussions with your virtual CFO about what that entails. Sort of what's that process going to be like? And that's a great question. That's a way that you can really tell the maturity of whoever you're working with is to ask them about their onboarding process. And if they answer and say, oh yeah, here's exactly what it's going to be, there's a 7-step process, here's the documents we're going to need from you, those types of things, that should give you some comfort that they've done this enough before, that they've probably figured out their solution offering. And once you've decided if it's a match for what you really want, then you should be able to get a lot of value out of that.
Right. So when it comes to things like, I'd say, we're that gray area of, are you legally representing the company or not, right? If I were working as a full-time CFO like I have in the past, there'd be no question, I'd review and authorize and sign contracts on behalf of the business, or I'd, represent the company to banks or lenders or investors, right? Because I'm a named officer of the business, I'm a fiduciary of the business, I'm an employee of the business. But if I'm a part-time fractional person, it's different. And so, what should I expect of a fractional CFO when it comes to kind of the legal gray areas?
And Cal, that's another great question to talk through with different firms as you're talking with them. Because, generally in our relationships, we set the expectation that we're your coach, we're your advisor, we will do a lot of the work, but at the end of the day, you're responsible for making the decisions, ensuring the accuracy of everything that's there. So, as an in-house CFO would, they'd put things together, but then other people in the business need to review them to make sure that they're right, to make sure that they're accurate. But you need to understand sort of what those roles and responsibilities are. So, for example, we may, on certain bank accounts, does the firm get put on those? To your point about, can they execute contracts based on, the nature of the relationship? Those are all great questions to understand. And I do think initially, when you're having these initial conversations, these are great questions to ask. And there's really no question that's off limits because every business is different. Every business is at a different stage of maturity. You may have tried a solution like this before and it didn't work for certain reasons. Well, with the next firm that you're talking to, talk about those reasons. Talk about why, what are the reasons that happened? And are there different alternatives or better solutions? Or the firm may look at you and say, sorry, that's an unrealistic expectation. We would do the exact same thing as your prior firm did. So therefore, unless you change your expectations, we're probably not going to be a good fit for you. And that's why that initial conversation, doing your research, following them on social media. A lot of firms publish a lot of information. They have different tools that they'll put out there. Looking at those and figuring out, are you going to get value from that? Because that's what the firm or the person that you're interacting with, thinks you'll find valuable. And for some businesses, that's 100% spot on. For others, it's not what they're looking for. And that's why you need to be an educated consumer in this space and make sure that you're asking those questions and you're having that conversation. And then figuring out, are the people that you're working with, are you comfortable with them? Can you share the intimate details of your business, what's going right and what's going wrong? Do you feel comfortable enough that you can have that open relationship? And the best relationships that we have are ones that are, where that trust and that confidence exists.
Right. I think, it's a little bit different than your straight accounting or controllership kind of role where it's policy, procedure, consistency. You don't need a lot of creativity. You might not want a lot of creativity in your staff accountant. You don't want them going off the rails, right? They got to follow the rules. But when it comes to a CFO engagement, it's a lot more consultative. It's a lot more creative. And I think that personality fit between the CFO and the CEO, is really important. Like you said, there has to be a high level of trust, and they've got to click to be able to work together effectively.
Yeah, and Cal, that's a key point that I think let's draw that point because you're making a good one, which is a lot of prospects that we talk to, they're frustrated because the firm that they're working with is only giving them results from the past. They're very focused on accounting for everything and making sure that everything's right, so they'll deliver financial statements to you that are accurate. However, most clients are frustrated most prospects are frustrated because that's not what they're looking for. What they're looking for instead, as you're referencing, is somebody that will really help them look ahead in their business. and make sure that they're really, we're talking about the future here. We're not talking about the past. I want to understand how you, as a virtual or a fractional CFO, can make my business better. How can you help me improve? And in theory, the virtual CFO should bring to you more experience or expertise in areas that you don't have. And where this solution is particularly valuable, let's say, you're a business owner and you're great at developing new solutions, or you're a salesperson, you're a natural salesperson, and that's your strength. Well, that's where having somebody that has this different skill set of a virtual CFO can help you, because that's not your natural strength. That's not the thing that you bring to the table every day. So a lot of times we have these conversations, and these are conversations that many small business owners have never had before, because they don't have someone on their team that has this area of expertise. So therefore, once you really start having these dialogues and you're like, man, this virtual CFO is helping me make better business decisions based on data, as opposed to me just crossing my fingers and hoping that it's all going to work out, which is another thing a virtual CFO should bring to you, which is really top line revenue is great, but at the end of the day, a business exists to generate profit. And so when you look at that, and there's a lot of situations that we go into, and a lot of small business owners, as long as there's cash in the account, we must be doing okay. And that's a real understanding of a virtual CFO can help you with margins, looking at your spend, trying to figure out here's where the business is underperforming, and here are 3 potential options that we could talk about on how you can fix it. That's the value that a truly effective virtual CFO solution is going to be able to bring to you.
Yeah, Dave, I think you're spot on about a couple points there. When I'm at SmartBooks, when I'm talking to a prospective client, I usually, part of that discussion inevitably involves, we can give you a bookkeeping and accounting solution that does a great job with the day-to-day transactional accounting and reporting on what happened in the past. But the difference between a CFO and an accountant or a controller, or a lot of controllers, some are great and forward-looking, but many of them are, classically trained accountants, where they're focused on accurately reporting the past. And when you're a business owner, what you really care about is what's going to happen next year, not as much what happened last year or last month, right? And so that's a key differentiator. I completely agree with that. And fractional CFOs can seem expensive, especially if you look at their effective price per hour. And so the key is understanding, I think, like you said, how are they creating value for the business that exceeds their cost? At some level, maybe they're keeping you out of trouble or fixing a mess. But really, once that project is done, like you said, it's about leveraging their experience, their skills to do the analysis, to figure out what are the right key performance indicators and operating metrics that really move the needle for the business. And they might not be able to tell you exactly what you need to do to get more profitable or grow, but they can focus you on the right set of metrics. And then you, as the entrepreneur who has the special sauce and the genius in your company and your industry, you can figure out exactly how to manage the business to improve those metrics.
Yeah, and that's where that distinction between, and that's important for people to look at, which is, that's great if I can get a general solution that handles these 7 things for me, but the thing I'm really going to find valuable is somebody that really knows my industry, knows those KPIs, and can tell me, if I own a coffee shop, does the person that I'm working with, do they advise 20 other coffee shops? Or, if it's a firm, do they have 50 of these types of clients? So therefore, they're to the point where they're starting to have benchmark data when they look around and talk about, okay, well, you have a unique kind of skill set on your team, so you need to think about compensation, because right now we've looked at what your compensation increases are that you're planning to do, and they're way out of line with the market. You think you're only going to give 3% raises. We see everybody else in our client base in the 7 to 8% range. So that's the kind of insights that somebody can bring to you. But it is, it's a difference, and the price point differs by this, different factors. And then also another thing, Cal, that we're seeing is also more of a combination of these types of things. So you may have somebody on your staff that's a great accountant that sort of handles everything that you need to do in the basic accounting, but that person does not have the skills to do really the forecasting and to do, the strategic business advice. So maybe you have somebody in-house handle the accounting, but you really need somebody with that, somebody's been there, done that, that has the deep, true CFO experience that can help you see around corners that you can't do on your own. So, and that CFO, you need to make sure that CFO is perfectly fine with working with your in-house staff. And, whether they supervise that staff or however that works, those are the types of things that you need to figure out when you're doing your research. What are even the options? And then which of those options and combinations is going to work best for me and my situation and my business, whatever maturity level that you're at.
Right. And one other point I'd make while we're chatting about, expectations that I should have as a buyer going into this kind of an engagement relates to this concept of delegation of responsibility versus abdication of responsibility. And I put out a video a few years back about this, I think in the context of filling the finance seat in a company that utilizes the entrepreneurial operating system, or EOS, which is an increasingly popular management framework in the small business space. And so in that framework, you've got their version of the org chart where you're supposed to have one person in each seat that owns everything related to the function of that seat. And so there could be a tendency to say, okay, I'm going to go hire this fractional CFO. They've got all this great experience. They've given me a great sales pitch on how they can help me. And so I'm just going to expect and trust that they're going to do everything that's needed to make my company financially successful. And I'm just going to go focus on something else that I enjoy doing more. And then, a few weeks, a few months, a year go by, and you're not financially successful, things are not going nearly as well as you expected, and then you can just blame the fractional CFO because they didn't follow through on their responsibility. And if it were a full-time CFO, maybe there's merit to that feeling of blaming them a little bit. But if it's a fractional CFO, they're limited in what they can do. They don't directly manage your employees. They're not full-time. They're usually remote these days. They're not involved in your day-to-day operations because they might only be working a few hours per week on average. So there are limits to what they can accomplish. And so it's hard to say, I'm just going to abdicate all the financial responsibilities in the business so I can go focus on sales or software development or playing golf or whatever it is I want to do instead of having to be involved in finance myself. And so, how should the CEO kind of navigate that dynamic in a fractional model?
Yeah. So first, I agree. So operating systems like EOS, Pinnacle Business Guides, fantastic solutions for small businesses. So in some ways, when I first got familiar with EOS, when I read Traction and some of the other publications, I was like, holy smoke, somebody's basically told me how to run a small business. I've been making it up for a couple decades. And I think, when a lot of small business owners see this, they're like, holy cow, it would have been so much easier if I would have had a business operating system like EOS or a Pinnacle Business Guide to guide my business or something like that. So I think there's aspects and merits to that. To your question, I think this is really the number one issue that we see, which is mismatched expectations. So, so to your point, if you think that you can basically pass this off to someone, well, that's definitely a conversation you need to be having with your service provider to say, here's what I want out of this. I don't enjoy it, so I want to spend as little time as possible. A good service provider will come back and say, okay, I understand that. This is not your natural strength, but let's talk about, there are 5 critical things that I need you to do. So whenever I give you financial statements, you need to review them. You need to make sure that they're accurate because ultimately they're your financial statements. I need you to be open and honest and candid in our conversations, and you have to tell me everything or else I can't be effective for you. Those types of things, and unrealistic expectations where somebody, as you said, says basically, I don't want to have anything to do with this, please take this, and they expect their books, which are a complete mess, to be fixed in 1 week. And that's the kind of thing where a good provider is going to sit down with you and say, okay, I understand your situation. We need to go through onboarding a little bit to figure out and understand exactly where you're at. And then once we understand that, then we're going to sit down and have a conversation about how long this is going to take to fix. So, if you're thinking it's all going to be fixed in a week and your firm is a miracle worker that can help get everything cleaned up immediately, hopefully you have a firm that will have that, the relationship and the dialogue with you about, this is probably going to take us 16 weeks, and here's why. Here are the steps that we're going to go through. And ultimately, after 16 weeks, we'll get you to where you want to be, but it is not a 1-week discussion. So whether it's when you're thinking about responsibilities, do you expect me to look after your full-time employee that you have on staff? Do you expect me to do coaching? Do you expect me to be doing mentoring? Those are the kind of things that you really need to customize your relationship to the things that are really going to be valuable to you, that the firm or the person that you choose is really good at, and that's the type of work that they want to do as well.
Right. I think I described it as a partnership more than a vendor relationship.
Completely agree. If it's a vendor relationship, you may get financial statements and that's great, but if you want a true, highly effective relationship that's going to impact your business, it's not going to be that.
Right. So I do want to kind of flip it to more the service provider side, how to successfully deliver fractional CFO services. But before we go down that path, is there anything else you think is important to highlight, Dave, on buying fractional CFO services and setting yourself up for success as the client?
Well, I think probably the one basic thing that I would say is that if you haven't looked around at this space, if you haven't thought about this before, I would encourage you to recognize that there are a ton of options that exist today that did not exist even a few years ago. With the pandemic and everything becoming remote, there are a lot of providers that deliver this service really anywhere in the world. And so you have a lot more options and a lot more models that have come out than before. So when you think about it, before it was basically, if I needed somebody, I'd go hire them. Well, now we've evolved and these fractional CFOs and virtual CFO relationships have come out. And there's a ton of different flavors. There's a ton of different things. So I encourage, you've got to do the legwork. You've got to do the research. Go out, find some of these solutions, look at them, and then have a conversation. Set up an initial call to go through and have a discussion with them. Find out the price point. Find out how they create value. That's such a key part, because there are so many solutions that exist today that just didn't exist before. So there are new ways to solve the problem that you may not even be aware of. So that's why the research is so essential.
Agreed. Okay, so let's flip to the other side of the table here, where we're trying to be a successful fractional CFO. What are the top few things that you believe in your experience go into successfully delivering fractional CFO engagements?
Well, I think there's several aspects to that. I think the first thing that you have to figure out is which segment of the market do you want to serve? Because I think there's a lot of discussion in the CPA world today about true niching and finding your specific thing that you want to do. And then because you can now deliver it virtually, your total addressable market can become significant. So let's say that you've got experience, you've got expertise in med spas or physician practices or coffee shops or whatever. Maybe if you're in a small town, and I think this is also one of the great sort of equalizers of this, is that if you're in a small town, you may only have 2 coffee shops that are there. But if you have that expertise, you can find how many coffee shops are there around the country. There are thousands that are potential clients and customers. But you need to figure out, what it is. Well, maybe it's coffee shops, but it's a specific kind of coffee shop or something specific. Those are the clients that you can deliver the most value to. So some fractional CFOs are, hey, I'll take anything. I've got experience, and so I can add value to any business. And a lot of that is true. Others are going to come at this and say, I'm sorry that, I'm glad you're interested in my service, but it's really not a good fit for you because we specifically specialize in this and this and this. And that's where it's important to understand what those specializations are and do they create value for you. So I think as a firm or a provider that wants to do this, you really have to figure out how you're going to go to market and what are the things that you're going to serve. Generally, what you'll find is the more deep expertise that you have in a certain area, generally that creates more value, so clients will pay higher fees for those, that specific specialization. So I think that's probably one of the initial things. Once you get through that, then I think you have to figure out your delivery model, which is, okay, so am I going to do this myself? Am I going to do everything, or do I need other people on the team? I don't want to do the back office accounting. I just want to do the FP&A, the cash flow forecasting, those types of things. So figuring out what your natural strengths are and where you're good at and where you're going to spend your time. Once you do that, then that will help you understand, this is my delivery model, so therefore this is the team structure that I need. These are the types of skill sets that I'm going to need on my team. And obviously not from day one, but as you grow, you should have a plan to scale. Because if you're really good at what you do, then you should be able to attract new customers. Because one of the things that we hear, there are a ton of small businesses that are very frustrated with their accounting relationship today, and they're looking for a new solution. So you'll have an opportunity to pick up new clients and market share. So you need to prepare to figure out, probably at the 8 client level, the 14 client level, that's when I'm going to need to hire and add an additional person. So just like small businesses, these firms that we work with, other virtual CFO providers, those types of things, they hit walls as well. And so they're a great 3-person team, but once they try to scale past those initial 3 people, it's really hard to do. So that's where, even as if you're launching your own virtual CFO firm, models like EOS are really attractive, because when you think about, man, if I could have somebody help me establish 90-day rocks. So every 90 days, I'm going to establish what are the most important things for my business that I need to get done in the next 90 days, and really focus on those, and then have a 90-day checkpoint where you're accountable on those goals, and then you look at the next 90 days. Same thing as any small business, you need to have that accountability yourself as well. So those would probably be sort of figuring out what your niche is and what market you want to serve, and then figuring out your delivery model. Those are probably a couple of the really key foundational steps that, if you're thinking about launching this business or going into this business, that you really need to make sure you do up front.
Right. And I'd assume, initially you're probably less picky about individual clients. Maybe you are trying to focus on a particular industry niche or segment. But maybe you're willing to work with a pretty wide spectrum of businesses within that segment, at least initially, when you're hungry for new business, right? But at a certain point, I assume the individual client selection becomes increasingly important. So what does that look like?
Yeah, and it is. It's one of those things that, you have to be careful with that, because if you take on a bunch of clients that aren't the right fit for what you want to do, it may help you get critical mass so that you can start to evolve to that stage in your maturity where you can actually specialize in that area. Or you may find that you're taking on a bunch of clients that aren't profitable, that are very high need, that you really don't have the expertise to add a lot of value in. So it's really, you have to look at both sides of the equation as it relates to that. If you have, let's say you've got, 2 decades of experience in a particular area, well, that's the kind of thing that you probably want to go out and figure out how you can launch specifically targeted at that niche. And then you may want to have and we help other businesses too as well, but you really want your go-to-market to be focused on that particular niche. As long as your service, it's really just about thinking through what you want to be. And you're right, Cal, there may be, in the short term, I've got to do this and this and this, but I've got to recognize after 6 months, 12 months, or once I pick up a certain number of accounts and I've gotten to a certain level of recurring revenue, that's when I want to really start, focusing and specializing. So maybe for the first year, your go-to-market is very general, but after that first year, you really start pushing that specialization message. And every new client that you pick up, you want it to be in that particular space, because those are the clients that you're going to be able to deliver maximum value to.
Right. We haven't really talked about pricing specifically yet. Maybe now is a good time to talk about pricing models for fractional CFO services. What are you seeing in the marketplace? And, typically I think it's either hourly or fixed price, but could you talk about, what determines what a good pricing model is in general for specific kinds of engagements? How do you manage that?
Yeah, and I think it depends on, once again, there are a ton of different solutions out there. So I think you're going to find a lot of different pricing options. It may even be a combination. You may have a firm that you agree to a specific price with, a recurring price, but then there also may be special projects. And then how are we going to handle the special projects? Is that going to be done on an hourly basis? So all of that, once again, what are the conversations you should have up front? that's one of the conversations that you should have. So what we're seeing more, kind of more so on pricing is that, clients don't really want the hourly model because they don't want to have to, because what that does is it inhibits that partnership. Because if I'm a virtual CFO, I want you to call me when you have a question. I want to be talking about the difficult business issues with you. I don't want you thinking about he's going to charge me an hour and I'm going to get a bill and all that kind of stuff. That model really inhibits a lot of that trust and that true partnership that happens, which is why what we're seeing more so and what we choose is basically we have a pricing calculator. As I mentioned before, we have 3 different levels of service. And then we have a pricing calculator. So based on the characteristics of your business, your revenue, how many AP transactions do you have? Do you want us to help with taxes? Kind of, we take you through a bunch of decision points, and then we'll create some scenarios for you. It's like, well, you talked about this. You said this may or may not be valuable for you. So here's a price with it, and here's a price without it. And then in our model, what we do, it's a weekly fee. So basically, we charge a weekly fee every Monday. We ACH the fee out of your bank account, and then basically you can leave us at any time. What we have to do is generate enough value for you to recognize, sort of the price that we charge is well worth it in terms of the value that we deliver for the business. And then if it gets in and after 6 months it turns out that your needs are a lot higher, or you made a guess on the pricing calculator and it's actually turning out to be different than that, then you need to have a relationship with the provider where you can have that discussion. Also, one of the things that we do is we have clients that adjust their service level. We may be doing all of their credit card reconciliations for them, and they come back, it's like, really, we only want you to do these 2. We can hire a bookkeeper who can handle these other things. And that's the kind of thing as well. This is an ongoing relationship. As you mentioned before, it's not really a vendor relationship. It needs to be a partnership relationship. And so that's key. So we see a lot of different things on the pricing front. And that's another great question if you're looking at these types of services, to really dig in and understand, is there a commitment? Do I have to stay with you for a year? How long's your onboarding period? What is your pricing structure? All those types of things. And the other thing is, do they provide other services? So there are both fractional CFOs and firms that have, like, for example, at my firm, not only do we have the virtual CFO services, but we have virtual CIO services as well. So we help clients with technology. We're a managed service provider. So for a lot of clients, that's great because they're like, I don't want to deal with either accounting or technology. I've stumbled there in the past. I need a firm that can just take care of that for me. And that's where also, what are your needs? So really looking at and understanding, is that going to be valuable for you, or really all you need is this? That's all part of the great conversations you can have up front with the potential firms that could help you.
Right. Yeah, I think the pricing's a key issue. And I've done both fixed price and hourly, and I will say that when we did primarily fixed price contracts, managing scope creep was an incredible challenge because, when you're signing up a new client, they want to underestimate everything to get the price nice and low. And then you start working and you realize, well, there's actually a lot more to do here than initially presented. And B, the client keeps asking me to do more and more because they think I'm pretty good and can help in other areas. And then I end up you're in a position where it's hard. You either, tell the client, no, that's not in the contract, which is not good client service, or you just kind of do it and don't charge for it, which is not profitable, or you spend a bunch of time renegotiating scope and pricing instead of just doing the work. And so my experience has been fixed price sounds good, but hard to manage. Maybe in a pure fractional CFO model, it's a little bit easier because you've got a very senior individual who's able to have a little more of that partnership push-pull relationship with the client to try to flex a little bit when needed, and some months maybe it's less, and maybe it works out because the scope is a little more manageable. But kind of where I've come out on it is, in general, we generally agree to an estimated scope of service. We know approximately what that's going to cost on a monthly basis. We have hourly rates that we apply. If something comes up that needs to get done and the client asks us to do it, we'll point out, yeah, this is going to cost a little bit extra this month. We're happy to take care of it for you. If it can be significant, we may give them a rough estimate of what it's going to cost, and then we spend our time and energy doing the work and supporting the client rather than renegotiating contracts. But everybody's got their own model, and some people make the fixed price work, some people make straight hourly work, some people make some other hybrid models work. All different kinds of models out there.
Yeah, and I think the fixed price model is harder to do because just the whatever hour we work, we charge you for it. That's fairly easy to manage. I think certainly I think what clients prefer is the relationship where it's fixed and they don't have to worry about it. So I think that's another good point that we really haven't talked about, which is what are you paying for as part of your virtual CFO relationship? Are you paying for when I need you, you will do the work? And that, so that's one type of relationship. Or are you paying for access? So when I do have a need, you're there for me. And and there are sometimes you'll have a client that has an issue, you have to spend more time on it, and then once business gets back to usual, you'll spend less time on it. But the client finds value because there's access. And when they need that expertise, they have access to that expertise. So, and I think on the the pricing point, you're right. Sort of the fixed is harder, but that's where when you talk to the firm, like for example, if you sit down with us and go through the pricing calculator, we're probably going to ask you 40 to 45 questions that you'll need to make a decision on, and we'll guide you through that process. But that's a result of having done so many of these types of relationships. We know where the problems are because we've been there and we've stubbed our toe. We've learned, yes, next we need to add that to the pricing calculator and have that conversation up front so that we can eliminate those uncomfortable conversations on down the road. That can give you a sign as well for the maturity of the provider that you're considering. Are they just giving you kind of one number and then they're going to come back and they're going to change order you? Or does it seem like they really understand what I need, so therefore whatever estimate they're giving me, I have confidence that that's really what I'm going to end up paying for this service?
Yeah, I think the good quality experience providers like Anders or like SmartBooks, we're never going to be at the low end of the price range. We're going to tell the client, here's realistically what it's going to cost to deliver this scope of service at a high level of consistency, quality, responsiveness. We're kind of counting on clients to appreciate and see through kind of the lowball offers that are not set up for success, and go with the offer that is probably going to be realistic and sustainable and successful long term. But that is a challenge too. There's so many different pricing models and so many different providers out there. I think on the provider side, we've got to make sure we're able to convey the difference between somebody who's quoting 40% less than we are, who cannot possibly fulfill a good scope of service at that price. But the client may not know that. They just see two prices for more or less the same thing and might not intuitively know the difference, right?
Yeah. And Cal, this client accounting services space, this CAS space, is basically new within the last decade or so. I mean, people have been doing it before then, but it's really come on strong. So I think, in some regards, there's a lot of players that are looking at this as today are the early days to get market share. So therefore, they will discount things to get people in the door, but then they know that they're going to have to raise prices to be able to do it profitably. And so I think just, when as a buyer, when you do come into that situation, I would look for those types of guides between, okay, what is this provider giving me versus this provider? And then what is the stage of their business? Are they at a point where they're picking up new clients and they're being very aggressive? Well, what happens if they have some success and get a lot of people on board? Are they going to have too many clients to deliver my service? Or are they not, because I'm not going to be a profitable client for them? Am I going to get really poor customer service? So those are all the questions as you go through that process that you need to make sure that you're looking at. But you're right, Cal, if you've never done this before, a lot of people aren't educated enough to really understand the game and to make good decisions based on that. So, which then leads you to another point, which is if I get into this and it's not for me, what's my out? Am I it's an annual agreement and I'm in for this full year, or is it like in our model, you can leave us at any time if we're not generating the value. Then once again, different pricing structures, and there's also different exit considerations as well. That also needs to be part of that overall, thought process and considerations that you think about.
Right. So let's say we've got a business that's growing, financially successful. They've been working with a great fractional CFO who's contributed a lot of value along the way. But at a certain point, they're thinking about going to a full-time position. Mm-hmm. How long and how large does the fractional model really work? And what are some of the signs or symptoms that it's time for the client to graduate to more of a full-time position?
Yeah, I think it's, if you have a good virtual or fractional CFO relationship, the CFO will be able to help you with that. So when we have client churn, it largely happens for two reasons. One is the situation where you've now grown to a point where you have outgrown what we do from a virtual CFO service. And that differs by business when that happens. That could be at the 20 million mark, 30 million mark, 40 million mark. It's different, for every business based on, where things are at. So I think, and the other thing is you may outgrow one solution, and then there's another solution that's going to be a better fit for you. So that may be a firm that specializes in, let's say you're in the 20 to 30 million space and you kind of outgrow that. Well, then you may need to look for a firm that basically has great solutions for $50 to $100 million companies in my particular space. So those are the types of things. But that transition process, which could be another thing that you ask about, which is, sort of I've outgrown you and I need to get my full-time CFO. Or the other thing that happens a lot of times is that we provide great advice and the business is successful and ultimately there's an exit. The business either gets acquired or, goes into something else and therefore we lose them as a client. But for some period of years, we've helped them become successful. And that's also, when you go in and have these conversations, I'd recommend that you share what are your goals. Are you nearing retirement and you want to be out in 7 years? If so, then the virtual CFO needs to be working with you on your succession planning and really establishing clear roles, getting documentation in place. There's a lot of things like that. And you need to it'd be great if you could find a virtual CFO that has that expertise and experience. That, I've been through that process 7 times before, so I know 3 years in advance the things we need to be talking about and the conversations we need to have. So that's also an important part of the relationship, is because everybody defines success differently. Every business, for some businesses it's top line, for others it's profit, for others it's more of a lifestyle business. And I want to make a good living, but I want to have a lot of free time to do the things that I enjoy. All of those things are a great conversation to have to level set and set expectations with your virtual CFO solution.
Yeah, Dave, that brings to mind another point I'd like to emphasize, which is I sometimes talk to clients about the different types of CFOs in the sense, if you're a closely held business that really needs to operationally upgrade and, scale over time, you're really probably looking for more of an operational hands-on CFO type. But there are other businesses that are looking to go out and do fundraising, an M&A transaction, buy side or sell side within a few years. And so you need kind of the fundraising, capital raising type CFO who may not be great at hands-on operations. But what you need to do is fundraise and prepare and execute M&A transactions, you need that expertise. Or for some reason, maybe you need an accounting-heavy CFO. And there's probably some unicorns out there who are great at GAAP and accounting, great at hands-on operations, and great at fundraising and M&A, but there aren't too many of those out there, right? So you got to figure out what type of background you really need based on what your expectations are for what you want the CFO to do for you.
Completely agree, Cal. And that's why that setting expectations and having those discussions is so important, because you're right. It is a very different skill set. If you're a more finance-oriented CFO who's working, basically on funding and growing the business and those types of things, as to more an accountant that's really focused on the accuracy of the financial statements and GAAP and those types of things, it's different skill sets. And so therefore, you need to understand, for what I'm trying to do, which of those options is best for me. And if you think you may want to exit in 3 to 5 years, you need to bring that up in your early conversations to say, hey, here's my business, here's what we do, here's where we're at, here's where we think maturity wise that we are, and here's our plans. As an owner, here's my perfect world. And then basically you should find out the virtual CFO solution, how well does that match with your particular aspirations? So Cal, I completely agree. You've got skill sets are very different. And if you want somebody that's been there, done that, then you need to ask that question as part of your initial process. Or you need to find out, hey, these next couple of years, we got to get things under control. We don't have good internal controls. We don't have documentation. We really need help with that. But then after those, that first 2 years, then we think we want to work on, really exit planning and, succession and those types of things. Can you help with both of those things? And the solution may be, great, we've got a virtual CFO who's going to work very well with you for those first 2 years. And then when you get to that latter point and you want somebody that can help advise you on, pitches and going on road shows and those types of things, that's probably a different virtual CFO. But what we can do is after 2 years, we can plan to transition that relationship. So we'll have an overlap period of 3 months to make sure that the more accounting focused CFO, the cleanup, internal control CFO transitions to that other CFO, but you can do it all. You can keep those relationships within a single firm where you can get the value for the whole journey of the things that you're going to need. But once again, in order to understand that, you've got to have good communications up front and do your research to figure out if people can actually provide those types of solutions.
Well, this has been a great conversation, Dave. I think we've gone into enough detail that we're trying to provide some pretty good information for the small business owner who's considering entering into a fractional CFO engagement or perhaps is not thrilled with their current engagement. Maybe help them understand a little bit better why it might not be working so well and what they might need to change or look for in their next engagement if they can't make the current one successful enough. Before we wrap this up, is there anything else, Dave, you'd like to mention on this topic?
Well, I agree. This is an evolving area. And, the solutions that exist today, there's going to be more solutions next year. So there's going to be even more options. So one of the things I do quite a bit is I post on LinkedIn. So I'm at linkedin.com/Dave Hartley. And so I post about everything from virtual CFO type stuff to cybersecurity to those types of things. So connect with me there. And then also my firm, Ander CPAs and Advisors, we publish a lot of thought leadership. And so if you follow, the firm on socials, I think that would be great. The other thing, Cal, I'd ask or I'd mention is that also I do co-host a podcast called But Who's Counting? So we're in season 3 now. Me and my co-host, Missy Kelly. Season 3 is really focused on innovation. So we're talking with small business owners about their innovation journeys, what has worked well, and then what are their tips for small businesses, entrepreneurs, on how they can innovate within their businesses. So those might be a couple of resources that your listeners may find valuable.
Well, great. Thank you very much for joining us today, Dave. I appreciate your time.
Thanks, Cal. Appreciate it.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.